You've poured your heart into building this business. The late nights, the risks, the wins, it's all part of your story. But when it's time to sell, buyers don't care about your story. They don't care how hard you work. They care about one thing. Will this business make them money without giving them headaches? Statistically speaking, only 1 in 12 businesses that go up for sale actually close. Not because the products are bad, and not because the founder's not smart, but because the business wasn't prepared to sell, or it looks too risky. Every time a buyer sees confusing financial reports, inconsistent profits, or no real systems, they just walk away. Think about it. If you're about to invest millions of dollars and maybe collateralize your house, would you bet on hype? Of course not. You would want certainty. Certainty that the cash flow is real. Certainty that the customers stick around. And certainty that this thing won't collapse the moment you sign the deal. That's exactly what buyers are scanning for when they evaluate your company. And when you give them that certainty, you don't just attract buyers, you create competition between them. And that's how you get multiple offers, a higher valuation, and the type of exit that you can rely on. So in this video, I'll break down the 9 things buyers actually care about when looking at your business, and how you can make sure your company checks every box.
Hi, I'm Nate Lynn. I sell companies like realtors sell homes. Specifically, businesses where the owner runs them remotely, like e-commerce, technology, internet companies, and professional service firms making anywhere between $1 to $30 million a year. I've been selling companies for over a decade, and in the last few years, I've sold 20 companies for over $121 million. If your business has strong cash flow and a buyer can run the business from any location, chances are I already know someone who wants to buy it. In fact, if that's the case, I guarantee I can bring you 30 serious buyers and get you an LOI in less than 4 months.
So let's start with the very first thing buyers look at. Risk. At the end of the day, buyers have one thing burned into their brain: don't lose money. That means before they even look for upside, they're scanning for downside risk. How safe is this investment? If your profits are bouncing all over the place, if this whole thing depends on you, or if your systems look shaky, those are all red flags to a buyer. But if your business shows stable, steady profits, thoughtful operations, if it has systems or people running it without you, then suddenly you're not risky, you're rewarding. And once the buyer feels comfortable that they're not going to lose money, the next thing they're looking for is your profit track record. Because here's the truth: revenue is vanity, profit is sanity. A business pulling in millions in sales might look impressive at the surface, but if the bottom line isn't growing, or worse, if it's shrinking, it's an absolute valuation shrinker. Buyers don't want flashy numbers. They want to know that the business can consistently keep making profit over time. And so does their lender. More on that in a moment. So if you can show a history of steady growing profits year after year, that screams reliability. That tells buyers, this isn't a fluke. This is a printing press of money. So you've shown buyers that the business isn't risky and you've proven that it's profitable. What comes next? They want to know if the deal is bankable. For any deal over $1 million, there's a 99% chance that there'll be a bank or lender involved somehow. And here's what they need: accurate, verified financials. Numbers and verification that lenders can actually trust. Numbers that reconcile from the bank statements all the way to the merchant statements. And any system in between, like a CRM, shopping cart, or accounting system. Because if your books are inaccurate, if the expenses don't line up, or if they look like they've been manipulated, or if they're missing something, the deal stops. Buyers don't want the brain damage trying to figure out what's real and what isn't. But when the financials are accurate and verifiable, buyers get real excited. Because now, not only does the buyer trust the numbers, but the bank or lender will too. And if there are verified profits, that makes financing the deal actually possible. So accurate and verifiable profits equals more buyers, higher offers, and faster closings. But here's the thing: accurate financials can get complicated if you take shortcuts. That's why buyers love the KISS rule. Keep it stupid simple. If the way you label your chart of accounts is so unique to you or complicated that somebody outside of the company doesn't understand it, or if you're using acronyms or terms that only people inside your company will understand, they're going to skip your deal and go on to the next one. They don't have time to solve puzzles. They want clarity. On the other hand, when your numbers are simple and straightforward, buyers understand them instantly. It feels transparent, it feels trustworthy, it feels credible. It matches the professional expectation buyers and lenders have for M&A deals. And once they've got that confidence, they're ready to look beyond the spreadsheets straight at your customers. Which brings us the next thing buyers care about: customer love. Because numbers can be bought, but customer love cannot. Which is why buyers pay close attention to what your customers say about you. Are people raving about your product or service online? Are there reviews, testimonials, or user-generated content about your product or service online? Are there any online communities that love what you do? Because nothing builds buyer confidence faster than proof that people love your product and keep coming back. And it's not about manufactured hype, it's about authentic love. If buyers see that your customers are true fans, not just one-time transactions, and that they keep coming back, they absolutely love it. Once that box is checked, buyers start to check out your presence out in the world. Which brings us to the next point: authentic publicity. See, customer love is powerful, but what really amplifies that is when the world starts to notice too. Buyers care a lot about publicity, but here's the catch: it has to be authentic. Now, getting featured on a major news site, on a TV segment, or on a podcast, those things show buyers that your business has real traction and credibility. But you know what doesn't work? Manufactured hype. Paid features that look fake or shallow PR blasts don't move the needle. Buyers can sniff that out instantly. Authentic publicity tells them, this brand is legit. People are talking about them. It has momentum. And once buyers see that kind of credibility, the next question on their mind is simple: will this momentum keep the money flowing? Which leads us to point number 7, which is recurring revenue. See, publicity is great for getting attention, but does that attention turn into predictable money? That's why recurring or repeat revenue is such a big deal. For service businesses, this could mean repeat contracts. For product companies, it means loyal customers who keep buying product month after month. When a buyer sees predictable cash flow, their confidence skyrockets. Because now they're not gambling on whether sales will happen. They can nearly guarantee it. And once buyers know the money's predictable, they start thinking bigger. How does this business fit in with what they already have? Or how can it be the start of something bigger? That's what's called strategic fit. If they can plug your company and customers straight into their existing customer base, to cross-sell services or products, to expand their reach with as little friction as possible, that's a huge win. It means your business doesn't just stand alone. It makes everything else they own more valuable. And the stronger the strategic fit, the more interested the buyer will be. But even with all that in place, there's still one more thing that buyers are looking for that turns a good deal into a great deal for them: scalability. Here's how they think: if this company's already profitable and stable, what happens if we add better systems, more people, or more capital? Does it grow fast or does it hit a wall? Founder-dependent businesses with no systems are tough to scale. But if buyers can see the untapped potential, efficiencies to unlock, markets to enter, or expenses to cut, they start picturing the upside. And that vision of growth, that's often what's needed to get them to pay a little more. So those are the 9 things buyers care about: risk, profit, clean numbers, stability, customer love, authentic publicity, recurring revenue, strategic fit, and scalability. Together, they're the checklist for an exit of a deal gone wrong or a life-changing exit. And if you want help figuring out exactly where your business stands with these 9 priorities, that's what I do. I'll show you how sellable your business really is, what buyers are paying attention to, and how to make sure you get the biggest exit possible. So if you're ready to start preparing for the biggest liquidity event of your life, click the link in the description and let's talk.